Tom. You're going to share now.
Okay, so first things first, I want to talk about just rates. Rates are up about 60 basis points across the board. This is in the last 3 weeks. Everything was with the Fed, talking about their moving rates. It's been built in for a while. And I thought after this one they would, because pricing has moved up over two points in the last, 45, 60 days. And my thought process was that's about as far as we're going to go. We're going to kind of level off in that mid-5 range. But something kind of crazy happened that nobody really picked up on yesterday, that I think could push us into the 6s pretty quickly once everyone kind of digests the Fed minutes. So they're kind of giving us a double whammy. The Feds have been buying mortgage-backed securities for a long time. Okay, they stopped it about 30 days ago. That was kind of their version of quantitative easing. And what that does is, when they're buying, that keeps the market healthy and vibrant and moving. But once they stopped, there was no demand. So what happened? Prices had to go up. Okay, so what I'm showing you here is real-time pricing on mortgage-backed securities, both conventional and government. So UMBS, that's conventional mortgage-backed securities, and then Ginnie Mae, those are FHA VA bonds. Okay, this is what truly sets pricing. The thing that was missed in from Fed meeting minutes yesterday was that the Fed said after the close they're going to stop their quantitative easing and start selling, not just stop it, but start selling their bonds. They have $6 trillion in mortgage-backed securities sitting on the balance sheet. So what's going to happen is they're going to start selling, they said, up to $50 billion a month starting in June. $50 billion a month is huge. So what will happen is they'll start selling into this bucket right here. If there's excess supply and no demand, what's going to happen? This is going to get much, much worse. So this pricing, we're going to lose this 4.5 coupon. We're probably going to be at 5.5 within 3 weeks. So my guess is we'll be in this low 6s in practically no time. And that's starting to get a little scary for me personally, because I think the Fed is going to dramatically overshoot by giving us the double whammy of moving the 10-year and dumping all these mortgage securities into the market. So if I'm out there looking at homes right now, I would run screaming and get them closed as quickly as I possibly could, because I think we're going up another point. I just think it's coming. The really super interesting thing to me on this as well is the Ginnie Mae, this number here, this Ginnie Mae coupon of 4.5 is 101.5, and this is the conventional mortgage-backed securities. It's the same price at 101.1. This normally should be, we would probably still be seeing, if this were a normal market, we would, instead of having a 4.5 coupon here, we would have a 3.5 coupon on the Ginnie Mae's as our top coupon. In other words, this coupon should be at least 103.5, and it's not. So the market is disconnected. It's just not. This is not a normal market. So if you have any clients out there who are considering, or even they're being, not aggressive in their offers, it's time to get aggressive and get a house before rates go up another full point. I think that's going to happen. So, sure. It's coming. I really do, and I'm really surprised that they're being so aggressive in dumping those bonds, because it's really, it's going to create a massive glut right here. Mm-hmm. This is no longer going to be 4.5. It's going to be 5.5. I would say in about 2 weeks. So the next time we talk, I'll show you this again, and we'll see if I'm right.
Right. So rates hitting the 6s, Tom. That's like 2006-07 levels, if I'm correct.
Exactly.
Right?
Yep.
Okay.
I mean, we were in the 5s in 2017 and early 2018 as well, but I really think we're going to the 6s like super quick.
Okay.
So I would highly advise anybody who is not either making an aggressive offer or who has been sitting on the fence to get off that fence and start making super aggressive offers and get a house before it costs them even more. I did a deal. I had a pre-approved borrower. They were in about the 380 range. They started looking for a house in the latter part of January, early February. At that time, the rate was 3.5. I requalified them. And now instead of being approved up to 380, they only approved up to 317 because the price, the rate having gone up 200 basis points, it caused a $400 a month increase in payment. So you just do the math on that. I mean, that's the same deal. If it goes up another 100 basis points, that same payment is going to go up $200. That's huge. So it's time to buy before it keeps going.
Great advice.
I don't mean to be. I mean, I don't want to be the sky's falling kind of guy, but I've never seen the double whammy that the feds are about to put on us. We'll see. I mean, I could be wrong, but I don't think so.
Yeah. Okay. Good to know. We'll get the word out.
Yeah. On the positive side, because the spreads are so huge, the private mortgage-backed security market is coming back and I mean, it's just screaming back. So we're starting to see product being developed to fill in the blanks, and especially in where FHA used to just own the market. I think the private mortgage-backed security market is going to come in and steal his business ultimately, which is a good thing because it's actually less onerous because of that upfront mortgage insurance premium. So that's the positive thing, because there's so much money to be made with these spreads versus short-term money that we should see some really interesting new products coming out, and that's about it. So,
okay.
What do you think? Any questions?
No. I think the message is very clear. Talk to the clients. Talk to people on the fence and explain the situation and what could possibly happen and let them make their decisions.
Exactly.
All right.
So,
all right. Anything else you want to cover, Tom?
Nope. We're speedy. We're getting our approvals same day. We're getting appraisals back in 2 or 3 days. So 3-week closes, we can do it. Let's do it. So
3-week closes. Good to hear. All right. Well, thanks for your time, Tom, and I'll attach the rate sheet to this video and look forward to talking to you again in 2 weeks.
All right. Thank you, sir.